Well, good morning and welcome to the bank. With me I've got John McDermott, who I'm sure you all know, Chief Economist and Assistant Governor. So the Reserve Bank today reduced the official cash rate to 2.25%. The outlook for global growth has deteriorated since the December monetary policy statement due to weaker growth in China, other emerging markets and Europe. Domestically, the dairy sector faces difficult challenges, but economic growth is expected to be supported by strong inward migration, tourism, construction activity, and accommodative monetary policy. The trade-weighted exchange rate is about 5% higher than projected in December. A decline would be appropriate given the weakness in export prices. House price inflation in Auckland has moderated in recent months, but house prices remain at high levels and additional housing supply is needed. Housing market pressures have been building in some other regions. There are many risks to the outlook. Internationally, these are to the downside and relate to the prospects for global growth. The main domestic risks relate to weakness in the dairy sector, the decline in inflation expectations, the possibility of continued high net immigration, and pressures in the housing market. While long-run inflation expectations are well anchored at 2%, there has been a material decline in a range of inflation expectations measures. This is a concern because it increases the risk that the decline in expectations becomes self-fulfilling and subdues future inflation outcomes. Headline inflation is expected to move higher over 2016, but take longer to reach the target range. Monetary policy will continue to be accommodative. Further policy easing may be required to ensure that future average inflation settles near the middle of the target range. We will continue to watch closely the emerging flow of economic data. So very happy to take your questions.
Governor, when did you actually make the decision to reduce the official cash rate? Was it following the Fonterra announcement?
We have, we have our forecasting exercise over about 3 days, and that was about a week and a half ago. We took the decision last Friday.
You talk about the difficulty that banks could run into with funding. Is that it's exacerbated, obviously, by low interest rates? How much of a problem do you see that could be? Because obviously they're not getting the deposits they want.
It's an interesting topic. There's been quite a debate overseas about the impact of negative interest rates, for example, and to what extent is that squeezing bank profitability, given that they might pass it on in terms of lending rates, but there's limits to how far deposit rates can fall. The situation we've got here is mortgage rates have been flat since the beginning of the year. Swap rates have come down quite significantly. But where banks are is, by and large, they haven't had to rely extensively on long-term wholesale funding. And those rates, in fact, have been going up since about the middle of 2014, partly because of credit issues associated with falling commodity prices. So to the extent that they can finance a lot of their credit growth through domestic deposits, they've been able to avoid having to go to long-term wholesale markets and pay the higher rates. Are we done? I'm sure we're not.
No way. Just wondering if you could give us an assessment on the dairy sector at the moment. You did do these stress tests a wee while back. Where are we at in terms of meeting in that stress test scenario, and how concerned are you about dairy?
It's certainly a challenging sector, there's no questions, and it's very challenging for the dairy farmers involved. If you look at whole milk powder prices, as we know, they're at $1974 US dollars a metric tonne, and they're down 60% since February 2014. You know, a big part of the challenge is that internationally you're still seeing milk supply increase. I mean, if you look over the past year, milk supply in the US has increased by about 1%. In Europe, it's up by about 6%. And that's in Ireland and Denmark and the Netherlands and places like that. And you've also got the Russian embargo. So a lot of milk products or dairy products that would go into the Russian market, and that used to be something like about 20% of milk exports out of Europe, are now finding markets elsewhere and competing for the Chinese market. So that's the sort of dynamics that are very, very difficult internationally. Now, we did some stress testing in October and November last year with the 5 major banks. We'll release the report on that next week. We'll publish it in a Reserve Bank bulletin. We looked at a number of scenarios, and the most stressed scenario we looked at was, in essence, one which had the current price in terms of the payout staying there for the best part of the next 3 seasons. Now, that's a pretty tough scenario. In essence, we assume that farm prices under that scenario would fall by about 40%. Now, the break-even price, if you look right across the dairy sector, the break-even price is probably around, we think, $5.30. We did a lot of work with Dairy New Zealand on this, so we think it's around $5.30. So under that stress scenario, what the results showed is that about 44% of the dairy debt would be impaired, and the actual default rate would be something like 10 to 15% of dairy lending. Now, bear in mind 2 things. 1, it's a highly stressed scenario. 2, that agricultural lending is about 10% of total bank lending. Now, a lot of the agricultural lending is dairy-related lending, but we're talking about, under this stress scenario, something like 10 to 15% of dairy lending being in default. Now, for the banking sector as a whole, do they have the capital reserves to be able to accommodate that? If that ever did eventuate, then we believe that they do. But the results and the bulletin will be out sometime next week. And we're happy to set up a discussion, a seminar, whatever people would like. We'd be very happy to meet with you if that would be helpful to discuss it.
Governor, what bearing do you think China has had on your decision today, and what impact might another sharp yuan devaluation have on the New Zealand economy and therefore your policy decisions going forward?
I think the challenge with China is that it's building up a number of imbalances that are serious. And I don't think anyone's looking at this sort of colloquial term, hard landing. I don't think anyone's looking at that for the Chinese economy at any point in time in the foreseeable future. But it's true that their manufacturing sector and their construction and building sector is very much under stress, in essence. I mean, the rate of growth is slowing very substantially. The other thing that's been happening has been a very dramatic build-up in corporate debt in about the last 6 years. So if you look at the corporate debt to GDP ratio, it's increased by about 70% in the last 6 years. Now that's enormous. I can't think of any other country that would have, in terms of the actual dollar build-up in debt, that we've seen anything like that. Now, a lot of it is in the state-owned enterprise sector, and I think a lot of the concern is that it's not being addressed, and partly that's, I think, because of what's happening in the other sectors, such as manufacturing and construction activity and all of that. So I think people are watching China very closely to see what policy measures it's taking. It did increase bank lending enormously in January. There was a big increase. And at the G20 meeting in Shanghai a couple of weeks ago, the Chinese made commitments about easing monetary policy and easing fiscal policy. And partly as a result of that, perhaps that's why you might have seen iron ore prices pick up very substantially. Now, you asked about a devaluation. How would it affect us? I mean, if China, I think, had a very significant and prolonged devaluation, it would, in essence, spread deflation around the world. It's so dominant in the international trading system. It's such a big, powerful economy that, by and large, every other currency would be appreciating against the Chinese currency. And I think that would pose particular problems for Japan, which exports a lot of its products to China. So we would be affected through the exchange rate, we'd be affected through whatever has caused the Chinese economy to slow. That would affect our trade volumes as well, and it would affect Australia.
Governor, can you tell us how much of a game changer was that inflation expectations number a few weeks ago? Was that central to your change in outlook for rates? And what are your expectations going forward? Do you expect a further deterioration in that measure, or would a further deterioration prompt you to have to rethink the rate outlook as well? And secondly, your forecasts suggest one more rate cut. Can you give us a little bit of a flavour around that? When might that occur? Is there a risk that you could have to go do more than that?
Look, we made this decision based on several considerations. I mean, it was the risks around the global economy. We've been talking about that for quite some time in recent speeches and other things. It was the fact that the exchange rate is now 5% lower, 5% higher than what we were projecting in the December monetary policy statement, and we've been talking about the need for a lower exchange rate for a long time. And I think probably there was a view that since the FOMC made its decision to raise rates in the US, the expectation about the tightening, the rate of tightening has probably changed. The market view has certainly changed on that. We looked at house price inflation in Auckland and said that's coming off, but it's still early days. At the same time, there are house price pressures building in other parts of the country. So all those things were part of the mix. There's no question about that. We were thinking about those a great deal. And then the inflation expectations data. I mean, we look at about 20 indicators for inflation expectations. So we're looking at market surveys, we're looking at our own model measures, and we're looking at market measures. The good news is that long-term inflation expectations are well anchored. But we did see that 1- and 2-year inflation expectations had started to adjust downwards, and that was a concern. So that was certainly a factor in the decision. Why have they adjusted downwards? Partly because inflation expectations are adaptive. You've seen inflation expectations fall in the US and in Europe. You've seen them fall in several countries. But as I say, they're well anchored at the long end. Our interest rate projections built in 2 cuts. As for a future cut, if it occurs or if more than one occurs, that'll really be just driven by the data that we'll be looking at very carefully. But let me see if John wants to add anything.
I'll pick on one observation because you asked where do you think inflation expectations are going. Now, those expectations, of course, are what people think about the future. So what you're really asking is what do we think people will think of the future? So you're running around about the second derivative, I think. So
you note in your report that inflation expectations tend to track inflation, and
Yep.
inflation is at 0.1% at the moment. So I'm asking, would it be reasonable to assume that inflation expectations will continue to drop? Is that part of your current outlook?
So, and I was going to get to that, but one of the ways you can anticipate things moving is they do react to current information, particularly on the headline number of inflation. And I think what we're seeing is the reaction to that are the short-term measures. And part of the move today and the plan for future interest rates is to guard against those expectations falling too much, particularly in the long end of those forecasts. So it's really about managing those expectations, trying to make sure that they don't fall too far from here.
Can I just ask about the Auckland housing market? Where is your concern level at with that? Do you feel that there's enough data now to say that it has cooled off enough to give you some headroom?
It's a tough question, and it's one I think a lot of people grapple with. We look at a number of pricing indicators for the Auckland housing market. One that we put quite a lot of emphasis on is the RINES data, looking at what's happened over the previous 3 months and comparing that to a year earlier, and looking in particular at a stratified index that takes out quality differentials as best it can. And that takes a lot of noise out of the system, so you're not just looking at what happened from 1 month to the next month and things like that. Now in September, house price inflation in Auckland was running at 27%. And at the moment, the latest data we have is the January data. And that 3-month moving average on an annual basis was down to 14%. Now there's some RINES data out today, I believe, or perhaps tomorrow. So we'll be very interested to see what the February data shows. If you look at consents, for example, consents I think are running at around 2,200, which is about a 10-year high for Auckland. That's up around 20% over last year. A lot of it's apartments, increasingly proportion of apartments, but it's still not enough. Auckland needs more rapid house building than the 9,200, given the shortfall of housing there and given the migration flows that are coming into the city. So will house price inflation continue to fall in Auckland? We certainly hope so. We'll be looking at the data very carefully, but we'll get a better picture on that probably in the next couple of months. Did you want to add anything, Joe?
This sort of follows up that particular one. You've got that net migrations coming off its recent highs, but still relatively strong. It's kind of a movable feast, this one, almost as much as the currency projections are. But I just sort of wondered how much you were going to be able to, how much growth is being, some of that GDP growth being driven by that migration and this construction that's going on, and how much that might have to keep continuing going before that house price, I guess, to keep that house price, those house prices coming off that you were just talking about.
Did you want to start that, Joe?
Yeah, I mean, what you're seeing is quite remarkable growth in this economy, but it's being driven by a very strong supply response. Most of it, where labour market participation has been strong. We've been having new people arriving, Kiwis not leaving. And so the growth per person hasn't been as strong as it might have otherwise been. So it is often a labour supply dynamic that's very important in this story. The other thing with net migration is, I mean, the numbers are very large, but it has both a demand and supply element. So in previous cycles, the migration story has been very strong on creating demand for housing, all the durable goods that go in housing and all the transportation and so on. And it's tended to be more inflationary. And the current cycle is a bit different. The net migration story seems to be very neutral for monetary policy because there's a stronger supply response this time than in previous cycles.
I think we all struggle with trying to forecast what's happening with net permanent long-term migration. If you look at the net migration delta or change, since the middle of 2012, in terms of people of working age, it's been an increase of around 130,000, which is very, very large. Now, our forecasts build in about another 120,000 on top of that. So that's very substantial. And roughly half, we think roughly half of that migration inflow is heading towards Auckland.
At the last MPS, you suggested that if the government were to bring forward infrastructure spending in Auckland, that might be helpful in terms of stimulating some inflation. Does the decision to bring the Central Rail Loop forward satisfy that request?
Well, the government, it's up to the government to make its own spending decisions and investment decisions. So it's not our prerogative to make those decisions. Look, the economy's growing, we think, probably around 2 to 2.5% at this point, and our forecast suggests that it'll grow around 3% per annum over the next couple of years. The government has a fiscal position that's broadly in balance. Certainly if the economy did get into trouble, and you would sort of say, well, what would trigger New Zealand moving into a recession? It would probably be something on the international side, possibly linked to China or elsewhere. Then the government certainly has plenty of scope to be able to come in with fiscal policy, just as we do in terms of monetary policy, in terms of lowering the official cash rate. Was I happy with the decision in terms of the extra $1 billion of capital spending? Yes, I was, in terms of the capital works that they had talked about. But did you want to add anything, John?
Yeah, I mean, the fiscal position added to the picture we were putting together. And then the governor's talked about, really there is now fiscal space to use fiscal policy flexibly in terms of the automatic stabilisers if it was necessary. I mean, that would happen, the decisions would be somewhere else, but we're probably in a better place. New Zealand's in a better place today than it would have been 3 or 4 years ago, when we had quite large deficits and projections of debt to GDP actually increasing. So the position's a little bit easier.
Governor, can you please elaborate on your concerns regarding the housing market pressures in other areas apart from Auckland, and are you considering any sort of proactive measures like LVRs before it gets to the stage that Auckland has?
Yeah, we're not considering anything on macroprudential policy at this point. If you look at what's happening with house price pressures outside of Auckland, you're seeing strong growth in house prices in Hamilton or the Waikato region, in Tauranga, and to some extent Bay of Plenty. You've also got house prices moving in central Otago and a few other places. A couple of things about that. I mean, if you look at the house price to income ratio, for Auckland, that ratio is about 8.5. It's very high. If you look at it for the rest of the country, it's about 5.1 on average. So Auckland's about 70% higher than the house price to income ratio compared to Auckland. Auckland's 70% higher compared to, say, the average for the rest of the country. So there's more scope, in essence, for house prices to adjust potentially in the rest of the country. Now, the good news, if you look at some of the consent data, it looks as if some of the consents are starting to increase in Hamilton and Tauranga, for example. So in other words, while house prices are moving up, it looks as if you're starting to get a supply response as well.
Governor, since your speech a couple of months ago about the PTA and not reacting to the drop in commodity prices, do you think that the bank's had a bit of a change of mind, and do you think cutting today might be seen by some as joining the so-called currency war?
We gave the speech in February, partly because we were concerned that some of the commentaries that we were seeing around the PTA were slightly simplistic, to say the least. Some of them were pretty simplistic. They seemed to have a view, well, headline inflation is low, without understanding or commenting on what was happening in the rest of the world about headline inflation, or why headline inflation was low in New Zealand, and what was the actual requirements of the policy targets agreement. So the speech talked a lot about what was happening in the international economy. It talked about why inflation was low, what were the supply side forces driving it in terms of international forces, globalisation, and in essence, globalisation, technology and demography, and what were the supply side forces acting here about dairy prices and oil prices, participation and migration flows and all of that. So we wanted to explain more about why inflation was low, and it wasn't just a New Zealand phenomena. And then we looked at the PTA and what does it actually say? And so I tried to explain why certain phrases were put in the PTA. Some of them were put in explicitly by the Finance Minister and the Central Bank for this PTA, and the reasons why we did it were spelt out in that speech. And then it basically said, look, what we're required to do is to monitor asset prices, and why housing prices in particular were part of that equation, and our requirements in terms of the efficiency and stability of the financial system, and our need to avoid, or our requirement to avoid, unnecessary volatility in exchange rates, output and interest rates. So it's a very complex document that comes together in a page and a half, and the speech was really trying to talk about why that the PTA was a much more complex document than what other people might be suggesting. Sorry, the second part of your question?
Do you think that some might look at this as the Reserve Bank, joining the currency war, or what some commentators are calling the currency war?
I wouldn't think so. I mean, we've been talking about risks around the international economy for quite some time. We've been talking about the fact that our exchange rate's been appreciating while our terms of trade have been dropping. We're a long way away from negative interest rates that you're seeing in, Denmark, Switzerland and Sweden and the European Central Bank and the Bank of Japan. We're a long way away from that. But I think it's probably fair to say that, pretty well most central banks would like to see their exchange rates lower at this point. I think that would certainly be fair comment. Did you want to add anything, John?
Yeah, maybe just to emphasise the point that decisions around today are really about trying to stabilise inflation expectations so that we can get future inflation towards the middle of the target band. And that's the primary motive. It's nothing to do with the exchange rate directly or joining the currency war.
Governor, I'm referring to your scenarios about increase in financial market volatility and consequently increase in funding costs for New Zealand banks. Now, this is the first time you're discussing it, I think, after several monetary policy statements. So what's the reason that you're talking about this? And I worry about this because what's happening today is the scenario you discussed in your September monetary policy statement. So what are the chances that this will play out? And if it does, do you worry that your 225 basis points buffer would suddenly start looking very less?
When we're thinking about the funding cost, this is an emerging trend, so it's sort of a new development. We're watching what it's costing the banks in terms of their funding cost when they're getting money from offshore. It really hasn't changed domestically, and that's still a large portion of our funding, so it's a marginal change at this point. But we do worry about what it might mean for the future, and really we're just trying to highlight it as a potential risk, and we'll be on guard should it accelerate. That's the point of this. And sorry, there was a second part to the question.
Yeah. If it accelerates, would you worry that your 225 basis points buffer would look less because we will then be going to 2008, 2009?
Well, that's, yes, an interesting point, but at least we have 250 basis points, which is more than many central banks have at the current state.
Governor, are you concerned that today's rate cut and potential future rate cuts could further increase asset prices, particularly in Auckland, the Auckland housing market, and therefore exacerbate some of the financial stability risks you've talked about in the past?
It's certainly something that we'll need to watch.
Governor, on the operation of the Policy Targets Agreement and whether or not the Reserve Bank is running an asymmetric view on that Policy Targets Agreement, which some people have said, is that a risk for the Reserve Bank's credibility long run if it's seen to be running an asymmetric, i.e. allowing inflation below 1% but not necessarily above 3%?
I wouldn't accept that there's an asymmetric policy response. If you look at the last speech that I gave in February, it really talks about what's happening to inflation, what are the drivers of it, what's happening to headline inflation, what's happening to core inflation. No, I wouldn't accept a view about an asymmetric policy response.
Governor, can you please outline the three main risks now to our economy, and whereabouts does housing market pressures sit with you now that you say that it's moderated in Auckland?
Well, I think we covered that pretty well in our statement. I mean, basically, we said that there are many risks to the outlook. Internationally, I think those risks are on the downside. We've seen the OECD probably about 3 weeks ago pull down its forecasts for 2016 to something like about 3%, which was the global growth for 2015, which was the weakest since 2009. I think it's quite possible that when the IMF produce their April World Economic Outlook, I think it's quite likely they'll reduce their international forecasts. The main risks domestically, they're certainly there on the dairy sector, the decline in inflation expectations. The migration flows are a big uncertainty, and what effect that might have on the supply measures that John talked about and the demand side, and what it might do for house prices. And the pressures on the housing market. How much are they really coming off in Auckland at this point?
Governor, could you talk about whether you think some of the global deflation, and therefore in New Zealand, is caused by structural changes in the economy, particularly whether there's been some supply shocks, particularly around new technology and the likes, and whether that makes reserve banks or central banks cutting interest rates to potentially zero or below, whether it makes it sort of a waste of time or somehow impotent.
Yeah, I mean, it's a very interesting question. There's certainly some global structural forces behind low inflation. And they're there in terms of globalisation itself, in terms of international supply chains and the efficiencies that come out of it. They're there in terms of technology, the costs of storing, transmitting information. The marginal cost is basically zero, as we know, and those factor costs have been falling for 25 years or more. And it's there in terms of demography. So there are structural factors that affect global inflation. I think in terms of our own economy, you see those forces operating on it, and you also see the fact that oil prices have been declining, which is a supply shock. Dairy prices have been declining, which is also a supply shock. We've seen strong net immigration flows, and to what extent is that affecting wage moderation in the economy? And you've seen increases in labour force participation, particularly with women and older workers. So there are a number of supply shocks. And I guess what you're asking in essence is the inflation targeting, flexible inflation targeting arrangement still appropriate? And if you look at central banks since the global financial crisis, I don't know of one example of a central bank that's abandoned flexible inflation targeting. And I don't know of one central bank that has lowered its inflation goal or its inflation target. And the view is still, and it's a view that we hold in this institution, and I think it's true amongst all the flexible inflation targeters that are out there amongst the central bank community, is that a framework that looks at to what extent you have output gaps in the economy in terms of the actual level of output compared to the potential level of output. Now, a lot of that has to be determined through modelling because you can't observe potential output, etc. Then output gaps are still a very useful measure to indicate to what extent you've got surplus capacity or otherwise in the economy. And if you have a positive output gap, then I think most central banks will believe that you will get increased inflation pressures. You might have flatter Phillips curves, but you would expect to get increased inflation pressures. So no one's abandoning that model that I can see. They're aware that there are structural forces operating on inflation, but they're still confident, as we are, in terms of that output gap framework.
Just one more from me. How do you see the housing supply issue in Auckland, particularly given recent political concerns in the council which might block some sort of unitary plan or particularly more intense development closer to the city?
Well, Auckland still has a significant supply shortfall and a real challenge there. I mean, I mentioned that building permits were running at 9,200, which was the highest in 10 years and up 20% over last year. But in essence, let's say you've got migration flows of, say, 60,000 coming into New Zealand, and half of them are going to Auckland. And you look at the occupancy rate for housing in Auckland, which is roughly about 3 per household, a bit higher than the rest of the country, then that's 10,000 houses by and large that you would need just to deal with the accommodation flow, to deal with the migration flow. Then you've got a shortfall, which the council says is roughly 15 to 25,000 houses, and you've got natural increase in the population as well. So Auckland needs more houses, and it's up to the Auckland citizens and their council to basically try and work this out. Well, thanks very much indeed.